Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. If you think back, you'll remember high yield's very simple past. Transactions were standard, and we frittered away the days with macroeconomic risks. Today, the transactions are much, much more complicated, and the due diligence requirements have skyrocketed. Now, if this seems overwhelming, it is. But our guest today is one of the most knowledgeable people on this topic anywhere I've ever seen. Meredith Mackey is partner at Fried Frank, where she advises clients on complex transactions, including leveraged loans and high yield. She also works on some securities law topics and general corporate issues. Prior to joining Fried Frank, she was at Goldman. She got her bachelor's from Boston College and her JD from UPenn. So welcome to the podcast, Meredith.
Thanks. Thanks for having me.
Now, there are two companies that sort of exemplify some of these things exceptionally well, and they're good examples. They're J.Crew and Chewy. So could we start with sort of the background on J.Crew, take us back to 2010 when we were all just sort of, babes in Toyland?
Sure. Yeah. And I think each of these transactions, J.Crew and Chewy, stand for the proposition that there are certain situations where the borrower can take assets away from their creditors, away from their lenders and their note holders. Often their documents let them do it. So on J.Crew, the first one, chronologically, and still a headline name, TPG, along with certain other investors, took it private in an LBO. It was about a $3 billion LBO, and that LBO included a $1.5 billion senior secured term loan. The sponsor borrowed money to finance the LBO transaction. Not unusual. About 3 years later, J.Crew's parent company issued $500 million of holdco PIK notes. Those notes weren't guaranteed by the operating company. They were issued completely outside the credit group, and because of that, they were never reported in the company's financial statements. So their lenders had no idea that this had occurred.
Right, but this was actually kind of common back then. The OpCo, HoldCo strategy was being used in lots of sectors that I remember. Even banks and insurance companies got into it.
Absolutely, and still exists today, right? Often for very good reason. A lot of times, OpCo creditors are completely agnostic and comfortable with HoldCo debt, right? It doesn't affect their claim.
Right.
But here, the company ran into trouble. And by 2016, they were PIKing interest. They didn't have cash capacity to pay interest on the PIK notes. And they were really questioning, J.Crew was really questioning about how they would pay these notes off at their maturity. So what did they do? They did now what we call a J.Crew transaction, right? It was a transaction they accomplished in 2 steps. The first step was to take $250 million of IP out of J.Crew International, which is a subsidiary of J.Crew. That subsidiary, J.Crew International, is part of the company's credit group, right? And they transferred it to J.Crew International Cayman Limited. Right. J.Crew International Cayman Limited was a non-guarantor, but still a restricted subsidiary. So it had no payment obligations. It didn't pledge any collateral under its loans, but it did agree to be bound by the covenants in the credit agreement. Now, you have to remember, IP in almost any retailer is a critical and very important asset. So this was almost like J.Crew's crown jewel, right? But the transfer of this value from a guarantor to a non-guarantor restricted subsidiary might be considered leakage, but it was certainly permitted under the credit agreement, right? The credit agreement has an investments covenant that limits investments in other parties, including non-guarantor restricted subsidiaries. But that covenant had a lot of exceptions, including what I will call a non-loan party basket. And that's a basket that was specifically included for making investments in subs that are non-guarantor restricted subs. That was capped at the greater of $150 million and 4% of total assets, right? So they have $150 million there. They also have a general investment basket that they could use for just about anything, right? Call it a rainy day basket. Yep. So they have $150 million under a non-loan party basket, $100 million under a general basket, and they have what we call their builder basket, which is where you can earn into investment or restricted payments capacity, right? That gave them another, call it $27 million. Certainly sufficient to transfer $250 million of IP from a loan party to a non-loan party. So that's step one, right? Now the IP sits with a non-loan party, but still in a restricted sub. Step two, they took that $250 million of IP assets and transferred it from that non-loan party restricted sub to an unrestricted sub. Right? So now,
Here we go.
Right? Because that's a transfer of value not only outside the credit group, but to a subsidiary that's not bound by any of the covenants. And they can do whatever they want, any type of financing, any type of dividend, right? Now, the J.Crew credit agreement had a basket in the investments covenant that said that investments made by non-guarantor restricted subsidiaries, to the extent financed by certain permitted investments, were allowed to be passed through to unrestricted subsidiaries. So this was the sort of trick. This was, as we called it, the trap door,
the trap door.
The trap door, or the pass through, or whatever. Right, the J.Crew trap door. And so that's what the company relied on to take those assets that had been transferred in step one to a non-guarantor restricted sub and pass them through to an unrestricted sub. Well, the lenders found out. How did the lenders find out? Because in 2016, J.Crew announced the release of the liens on the IP that had been transferred to the unrestricted sub. I would just say that sort of all hell broke loose, right?
Yeah, I forgot about this part. So do you remember who figured that out first? Because it is a little bit of a trick, right?
I think that under the company's credit agreement, when guarantees and liens are released, it's pretty typical that they report it to the syndicate, or at least to the administrative agent, who then turns around and reports it to the syndicate. Right. Often there are a few little pieces of paper that have to be signed by the administrative agent to effect the release of liens, because they wanted to move these assets to this unrestricted sub and finance them. They had no fun doing that with any liens or guarantees, so they had to make them go away. And in order to do that, they had to let the syndicate know. On the heels of that, Bank of America, who was the administrative agent, resigned, and Wilmington Savings was appointed as the successor. Highlighting that because it's pretty typical for an admin agent to resign when things might be getting a little squirrely, if you will. In early 2017, J.Crew requested a declaratory judgment from the Supreme Court in New York that the transfer of the IP assets was actually permitted under the credit agreement. And in June of 2017, they commenced an exchange offer where they took those PIK notes and swapped them out for new super sweet senior secured notes issued by the unrestricted subs that held those crown jewel IP assets, along with some pref equity. They simultaneously solicited a consent from their term lenders to ratify that transaction, and they repaid $150 million of that term loan, right? So that's a great outcome for the term lenders. They got to vote, and they got a pro rata repayment of some of their debt. And about 85% of them said okay. Well, about 12% of the dissenters went and sought a TRO to bar that exchange offer, but their claims were denied. Following that, a couple of lenders sued J.Crew on the grounds that the transfer of the IP assets constituted a release of all or substantially all of the collateral, which would have impacted another covenant. You can't sell all or substantially all without 100% lender vote. But later that year, two of the lenders under J.Crew's term loan sued on the grounds that the transfer of IP assets was a release of all or substantially all of the collateral, and a release of all or substantially all would require 100% lender vote, not just the majority that they conducted, right? They also said that the transfer of the IP was a fraudulent transfer, right? The New York Supreme Court dismissed the fraudulent transfer claims with prejudice, and that was affirmed by the appellate division. And the claims related to all or substantially all proceeded to discovery. We never got the end of the story because then in 2020,
we had something else happen.
I seem to recall. And COVID had so significantly impacted J.Crew's business that it ultimately filed for Chapter 11.
And all retailers, right?
Yeah.
It wasn't just J.Crew.
Absolutely. It had nothing to do with this transaction, quite frankly. Just had to do with COVID affecting their performance. And then, in September 2020, they emerged from Chapter 11. Right. But probably the most interesting part about this is the market's reaction, right? Because in response to this trap door or pass-through, which allowed a two-step transfer of value from the company to restricted subs and from restricted subs to unrestricted subs in reliance on that basket, credit agreements now and indentures now typically include J.Crew language, right, which is designed to restrict or prevent the transfer of certain types of collateral. Most often it's limited to material IP, outside, not only to unrestricted subs, but outside the credit group. And the language has a number of different formulations that vary in strength and severity, but all the language is intended to override the use of RP baskets, investment baskets, asset sale baskets, to cap the value that the borrower could otherwise transfer away from the credit group. And various formulations of this are now considered market. You'll see it in almost every credit agreement and indenture. And I think most lenders and bondholders now have on their checklist a requirement that the indenture or credit agreement that they're buying into contains some sort of J.Crew protection.
Right. Something that closes the trapdoor.
Something that closes the trapdoor. Exactly.
Yep. Okay. So the other excellent example of the complexities that have risen over the last couple of years is Chewy. Would you like to take us back in time to the beginning of Chewy?
Yeah. Another headline name and another good example of a situation where a company was permitted to transfer value outside of the reach of its creditors. In 2014, BC Partners bought PetSmart for $8.7 billion. They financed it in part with a $4 billion term loan, $1.3 billion of secured high-yield notes, and $2.6 billion of unsecured high-yield notes. This was all part of the financing of the LBO. Fast forward 2 years, and in 2016, BC Partners used PetSmart to acquire Chewy for about $3.25 billion, which was one of the largest e-commerce transactions at the time, and brought PetSmart's total debt to about $8 billion. Right. Come May 2018, as many brick and mortar retailers did, PetSmart had financial distress, and its debt was trading in the secondary market at between 40 cents for the high yield and 70 cents for the term loan. And they had a 30% decline in year-over-year EBITDA for the year ended 2017.
Right. That's year over year. That's enormous. Yeah.
Yeah, that's not great.
Yeah.
So in situations like this, not uncommon for the company to look to capture some additional value, create some additional liquidity. And in this situation, how did they do it? Again, a two-step transaction where the company did a partial spin-off of Chewy. Mm-hmm. Remember, Chewy is the e-commerce business. Mm-hmm. And so actually, again, similar to J.Crew with the IP, Chewy is the crown jewel of PetSmart, right? So step one, BC Partners took 20% of the equity of Chewy and transferred it outside the credit group to an entity controlled by BC Partners. Right? This is a dividend, right? It's just a distribution of 20% of the equity. And so that a dividend requires restricted payments capacity under the debt documents. PetSmart disclosed that its valuation of Chewy was $4.4 million. So by my math, the 20% dividend requires about $890 million of RP. BC Partners had made a $1 billion equity contribution to PetSmart to fund a portion of the Chewy acquisition. And this contribution had actually earned PetSmart the ability to make restricted payments under a prong of its builder basket. And that's actually very typical. Dollars that go into a company can often increase RP capacity under the rationale that the same dollars can be used to fund a dividend. Dollar in, dollar out. In addition, the company had use of a $200 million general basket for restricted payments. And as is typical, they used up their baskets first and then looked to their ratios. So that was step one. By my math, $890 million is less than $1.2 billion. Step two, BC Partners took another 16.5% of the equity of Chewy, and they transferred that equity to an unrestricted subsidiary. That's not a dividend to the sponsor, much like J.Crew. Making an investment in an unrestricted sub requires investments capacity. Now remember, the valuation of Chewy is $4.4 million, so 16.5% is about $735 million. So the company needed $735 million in investment capacity to make this investment in an unrestricted sub. So the baskets that they used to come up with $735 million of investment capacity included a $200 million starter basket under the builder basket, which just basically says, we know you're going to earn into investment in RP capacity, but we'll start you off, right? We'll start you off with $200 million. Builder baskets typically accumulate over time, building with 50% of consolidated net income since the date of, the issuance of the notes or term loans. In this situation, that gave them about $393 million. And again, remember, they had the $1 billion equity contribution from BC Partners, less the money they used to make the RP, which was $690. Again, the math is a little hard to follow, but they used their $200 million general basket first to make an $890 million RP. So they had $690 left. That leaves them, by my math, with about $900 million under their builder basket. And again, by my math, $900 million is bigger than $735 million.
It is.
So they had capacity to transfer this 16.5% interest under the unrestricted sub. Once again, chaos ensues, right? So in 2018, they declared the dividend to the parent company of the 20% interest in Chewy and made the 16.5% investment in the unrestricted sub. At the same time, under pressure from lenders not to permit the release of the guarantees and collateral, remember, there's no point in having this stuff outside the credit group if it's still the release of the guarantees and collateral as part of the transfer. Citi resigned as admin agent and told PetSmart and BC Partners that 50% of the lenders took the view that PetSmart was in default under their credit agreement because they did not deliver sufficient information about the Chewy spinoff to lenders that requested it. Well, PetSmart was not happy about this, and they sued Citi in SDNY in the Southern District of New York for a breach of contract, and they sought a declaratory judgment that the spinoff was permitted. Remember, Citi had resigned. The PetSmart term lenders appointed Wilmington Trust as successor admin agent. And Wilmington Trust filed a counterclaim against PetSmart, seeking a declaratory judgment that the spinoff was not permitted under the debt agreements and also that it was a fraudulent conveyance. Once again, we never heard the court's view on exactly what happened because PetSmart and Wilmington, on behalf of the lenders, entered into a settlement in 2019 where Wilmington withdrew its complaints and they were dismissed with prejudice. But in exchange for that withdrawal, the term loan lenders ratified the transactions, but they also got a 50 basis point consent fee, increases in interest rates, favorable revisions to covenants, and a $250 million pay down of their debt. So a pretty sweet deal for them to agree to the transfers that were arguably permitted in the first place. Once again, you're going to sense a theme here, but once again, in response to this transaction, most lenders now and most bondholders now push for Chewy language in credit agreements. Well, what does the Chewy language look like? This is language that would prevent the automatic release of guarantees and collateral of a loan party upon a transition from it being a wholly owned sub to a non-wholly owned sub. Pretty often, non-wholly owned subs are not required to guarantee the parent's debt or pledge collateral to support the parent's debt because the third party minority holder is usually like, I am not interested in that. Once again, wide variance in formulations in the market about what the language looks like, but the spirit of it is to allow for guarantee and collateral releases only if certain criteria, subjective or objective, have been met. Maybe the transfer has to be to a third party. Maybe it can't be to a newly formed entity. A number of formulations are now considered market, and virtually all credit agreements and indentures entered into since 2019 now restrict the ability to release liens and guarantees for these types of what I'll call intercompany transfers.
Right. The crux of the Chewy thing was that.
Exactly.
Right. Okay. So now let's look forward, because this is where why I think this is such a timely thing, why it's so exceptionally important for people who work in investments to understand the complexities here. Is partially because their clients are clamoring to them for larger bond portfolios as interest rates rise. But we also know what happens to high yield borrowers when interest rates rise. So,
Yeah. Yeah. I think taking out my crystal ball, I think there will be no shortage of liability management transactions going forward, depending on, sector, industry, or specific company performance. And I think it will come as no surprise to any of the listeners that credit agreements and indentures often contain significant flexibility for companies to transfer assets out of the reach of their creditors, right? We've gone through the specific baskets that J.Crew and Chewy have used, and they became sort of examples in this market. But virtually any credit agreement or high yield bond indenture that you will look at will certainly contain a builder basket, will certainly contain a general rainy day basket, will certainly contain numerous other baskets that allow for the transfer of assets. Those baskets can be used for this type of liability management transaction in the case of a rainy day. A number of companies have actually done such liability management transactions, and now you hear about Envision and Dish, right? So I think that trend will continue, and it's important to have not only a solid foundation in your documents, but a strong relationship with the company and the sponsor.
Right, because that's where you're going to hear it first. Like in these cases, the first place that bondholders en masse knew about it was from the bank, essentially, right?
Correct.
So, yeah. So that's an exceptionally important thing to point out is if you're going to be managing a portfolio of bonds, you better have some friends at Citibank or someplace like that that
And
who can help you see that.
and also have a good line into the company's management team, CEO, CFO. Those folks do understand often their documents and the capacity. These transactions are rarely entered into without thought. They often get escalated to senior management and discussed thoroughly with counsel, with the board, and with the company's private equity sponsor, if applicable. So a good line into the CEO and CFO is also critical.
Right, but that is easier said than done.
True.
One of the things that has happened in the sort of post-COVID era is a lot more relationships are conducted like that over Zoom. And those are not as strong, right? Statistically, they're not as strong as when we used to all get in planes and go around and visit people. So,
well, and often with companies of this size, right? You're talking about Chewy, where they have, a $2.5 billion slug of debt. They have dozens and dozens of bondholders.
Right. So yeah, the obligation is huge. One thing I will say about Chewy is if the box is in the lobby of my building or any indication, Chewy's going to be fine.
Two of my favorite retailers.
Yeah, right. So, well, Meredith, thank you so much for sharing your absolutely voluminous knowledge about this stuff. It's really impressive. And thank you so much for being here.
Thank you for having me. This is really fun.
And thank you for dialing into this podcast. I hope this has been a very valuable thing to you, got those things rolling, and got you curious about what else you can learn on behalf of your investors. Until next time, this has been Compound Insights, and I'm your host, Rob Rowan.